Hey, welcome to the closing beat, everybody. How you doing today? Everybody doing good? What is this homework? You're stressing me out. I'm like, did I not do my homework? Or what is the homework? Someone tell me. I gotta know. If you guys need a test, I can certainly give you a test today. You let me know. But welcome to the closing beat. Slightly nervous closing beat today. Hopefully, I didn't say something I wasn't supposed to. Hope you guys are doing great. We are financial advisors here at Jazz Wealth. Hope you check us out. And a great one today. While other advisors are playing checkers, we're playing chess. Was working through a withdrawal strategy with a client, and we just couldn't quite get it right for the, to stay under the ACA limits. And come to find out, one of his goals was to buy a sauna, which is popular up north, not down here. And I was like, wait a minute, we could just use your HSA for that. That won't count against anything. And he's like, I can buy a sauna with my HSA? I'm like, you're damn right you can. So we were able to solve it by just taking the extra step, thinking through things a little bit. So I love it, man. Come check us out at jazzwealth.com. And in the meantime, I will teach you guys. We'll just keep teaching lessons and everything like that while the market just seems to be going higher every single day. This would be day number 7, so I thought that'd be kind of fun. On the 7th day, we rallied again, right? Just went higher. So we're back above the 50-day moving average here, and all of that's good, right? We're happy with, the whole bad news is good news type environment we're living in now. Like when there's bad news on the, spending front, it means good news because the Fed won't raise rates, right? So it's really weird how that's going on. The economic data, before we get started, continues to show that the sort of post-COVID momentum is certainly slowing there, but there's no obvious, large, massive sign of a slowdown yet. It's not there. Right? So think of the manufacturing numbers that came out, payroll numbers that came out, right? Jobs and everything like that. You go, well, there is indication that we are slowing the momentum from after COVID, but that was astronomical. That was off the charts. So I've kind of been approaching things lately as in, are we slowing down recession-wise, like, doom and gloom? Or are we slowing down just because we all went so crazy there? I've given you guys a hard time on that. I'd like to take a look at a few things here. I shared this in our notes from Jazz. What we can do is we can go look at individual companies because they just reported their earnings, and we can see, using the most popular metrics that each company likes to use, is there a slowdown? And if so, what type of slowdown is it? Is it after COVID momentum slowdown, or is it just really bad slowdown economically? So here's Caterpillar. Remember last week we talked about the sort of one negative for them was their backlog of orders had dropped by, a couple $1 billion. So it's like, oh, that's a big deal. But when we plot it out and we actually look at their backlog, they report this. This is not my information here. Backlog for Q3, $28.1 billion. Okay, that's a slight decline. But it's coming out of this whole ramp up from COVID. So if we compare that to sort of the long-term growth average, we're way above where we still should be. So I was making the argument in our Notes from Jazz email, I send it out every week to clients there, that, yeah, we're slowing down. This is post-peak economic cycle. And it's a dangerous time because we don't know how much we slow down. I'm not saying this is all nice and rosy, but it's not chaotic there. You can even look further. I'll share a couple more of these here with you. If we look at Starbucks' total same-store sales numbers, and we just look at the percentage change, right? Real simple. If you look through here, yes, they slowed down, right? 8% in same-store sales versus 10 versus 11. Yeah, a little slowdown, but nothing crazy. We can look at McDonald's, their store sales. I was just on a tear the other day. I started kind of picking through things. And I was like, all right, well, let's see, what we can pull up here. Oops, sorry. McDonald's store sales. All right, declining, but coming off of a nice strong run, right? And where's the other one? Oh, I didn't even put it in there. American Homes. Same thing. American Homes wasn't necessarily store sales. That was rental growth. Rental growth is declining, but still super strong. And we know it because we're out there, living it. So just a couple things to look at there. That if you look at an individual stock that just reported earnings, go find their most popular metric there and just look at the numbers. They're going down a little bit, yes, but it's not totally crazy. What is totally crazy is y'all with your $1.8 trillion in credit card debt. I saw this pop up on CNBC and a couple other places there. I don't think it matters. And we're going to go through all of that. I'm going to do a Jazz After Dark. I'm going to go through actually that entire Fed report and make it visually really simple and interesting to look at everything from mortgage debt to student loan debt, credit card debt. I'm just going to show you where we stand because the number, the headline, Americans have 1.08 trillion in credit card debt. Well, it doesn't sound good, right? But under the surface, it's actually, I mean, it's not good, but it's not chaotic and doom and gloom sort of thing there. So we're going to take a look through that and see how they came to those numbers, because they don't just literally look at every single credit card out there, by the way. You think they do, but then ask yourself, how'd they come up with exactly 1.08 trillion? Why wasn't it 1.08652 for whatever? You know what I mean? So we'll show you how they come up with those numbers. We'll do that for you guys there. Also, apparently you guys don't care that you have all this extra credit card debt, that you're spending money, that you don't really care about your budget, because Mint is shutting down. Did you guys know that? The budgeting app Mint that's owned by Intuit, they're like, so close it down. Nobody cares. Nobody wants to see this credit card debt on their phone every day, so we're going to close it down. Anyways, a little bit of a side topic there. The S&P back above the 50-day, like we mentioned there. In the last 7 days, it's gained half of what it normally gains in an average year. So we've done half of a whole year's worth of average gains in 7 days there. Ask yourself, will that continue? Is it normal for this rapid of growth to continue in an index, a stock, or whatever? No, it's not. It's not at all. The last example I gave you yesterday was gold. Gold had a very rapid rally there. What's happened since then? It's got to catch its breath to take a break here. People are smart. They know I can't keep paying higher and higher prices for gold and expect what happened from here to here to go from here to here. It's just not going to happen. Anyways, if we look at the S&P here, we are up, 14% year to date. That's pretty good. The trouble is the top 3 sectors today provided all of the gains. So consumer discretionary, we just went through this, so this is a great kind of review. We just went through this. Tech and communication services. If it weren't for those 3 today, you wouldn't have a higher market, believe it or not. That's not an opinion. That is it. And this goes back to this slide here. 27, or let's call it 28% of the S&P is made up of technology. They could pretty much call their own shots there. Consumer discretionary communication services, we're darn near 50%. If just those 3 sectors, I remember like sharing this with you going, hey, if just those 3 sectors have a good day, then the stock market would have a good day. Just those 3 sectors had a good day today. You had consumer staples and healthcare. Yeah, tiny little gain. Nothing really to write home about. Just a 0.1% gain. Big deal, right? 1% gain in consumer discretionary, 1% in tech, 0.5% in communication services, and that's how you get to that magic rally or continuation of the rally that we've had here. If we go over to the NASDAQ here, oh, by the way, 6 of the 11 sectors, right? 3, 6. Yes, 6 of the 11 sectors in the S&P were down today. And like, not just a little. Energy down 2.2%, materials down 1.9%, real estate down 0.8%. So these aren't like little declines there. NASDAQ is basically the same in terms of its growth over the last 7 days, accounting for the half of the average yearly gain that we see. So an impressive rally over there as well. Year to date, this one's kicking butt, man. The NASDAQ up 30, we'll just call it 40% year to date. The Dow hovering around 3% year to date thanks to this rally. This decline here took it negative for the year. And now, it's back up again. So it's all good there. And a lot. I wanted to show the Russell. And Russell 2000 is almost flat for the year. So after all this, what do we got? Small cap stocks. Just smush this down a little bit. We didn't quite get to 20%, so from high to low, basically 19% so far. But after that last rally that did participate better than all the other indices in the last couple days here, we're back to even so far year to date. Energy, the worst performing sector today. This is why. You got your oil pulling back here. Hey, okay, not a lot to worry about out there. Everything's good. Demand is strong. You know, it's what they're believing today. And if you look at bonds, those of you that want to take on more debt. Okay, it's getting a little bit better out there. 30-year mortgage falling ever so slightly on a day-to-day basis. And then you got the 10-year bond moving away, now sitting at 4.569. That's a lot better than that 5, just a touch over 5 that we saw, so that's pretty cool there. All the action today was in large cap growth. All the weakness today was in small cap value stocks. So if you go over to the Russell, well, hey, look what happened. It was the only index that was down today. That's because small cap value stocks, the beaten down, sort of out of favor stocks that are supposedly trading at a value, they had no participation, whereas they did the other day. Right? So remember, big strong rally on the way up, just like you see here. Big strong rally to buy the weakest stuff you can find. Well, that's only kind of interesting going into the end of the month when the statements go out and you want your clients to see nice, pretty statements and stuff. Now we realize, oh, I don't necessarily want to spend that much on that stock. I will sit back and I will wait. All right. What do we got here? Stocks in the news here today. NVIDIA moved ever so slightly higher, but some news overnight that Baidu has gone to Huawei instead for their chips instead of NVIDIA. And so it did initially hurt it, but not too big of a deal there. And it's not necessarily new news there. In the energy space there, most things real weak, had a tough day. Oil prices, energy, expensive or falling. But Diamondback Energy actually did pretty good. Beat on earnings. It was a good earnings report overall. And their averaged, average hedged price per barrel was about $80. It's actually really good for them. Next up, we got Uber. Ta-da! Uber reports earnings better than expected there. Gross bookings, $35.5 billion there. That's like a 20% increase, somewhere around there, looking over to the previous quarter, year over year, I should say. And more interestingly, I've given these guys a hard time. 1, 2. Yeah, we have 2 quarters now of profits. Okay, there you go. I used Uber this month. I used it a handful of times, so I'll take a little credit for that. That stock, by the way, is up. That makes it up over 100% for the year. So one of the bigger gainers here. And also, I see a little note here that they are now eligible to be in the S&P. I saw the Barron's thing earlier that said they would officially be now the largest company that is not in the S&P. So S&P didn't comment on that one. They just said, go look at our rules, right? So maybe a hint there as to what could be coming if they keep it up. They're technically eligible, but no word just yet. No word. All right, up next, you got CVS. I thought this was cool. CVS wants to, they see the profits being made in the insurance space, especially in the co-insurance space, but that's not what they do. So they see the profits being made there and said, we want to expand our market share in the insurance space. So here's what we're going to do. We're going to more aggressively, that's their words, more aggressively price our Medicare Advantage programs next year in hopes of bringing in all that stuff and getting more business, getting to be known for doing this stuff. And then by 2025, we should recapture the decrease in margins that we had. Think about your business. You sell hot dogs on the corner, right? You want more business because there's another guy selling hot dogs. You price your hot dogs more competitively. People get used to, that's where I go for the hot dog. I'm going to get a good deal if I go there for the hot dog. And at some point, the prices go up, right? And so that's what they're essentially doing there. That's a really easy way to go through it there. Dr. Horton absolutely killed it. Beats on earnings. And I wanted to read through this and see a little bit more. Here's what happens. Higher margins. Well, how's that? Don't things cost more? Aren't there less people buying homes? So what they said was, thanks to tight supply and lower build times, that allowed us for a higher profit and more volume on our terms and our schedule there. So they killed it. There's not much else to say. They have earned that rally today. Elsewhere, you've got, I'll take your questions if you have any questions. I'll let them load up there. Earnings continue. It is the thick of earnings season, and so far, pretty good, right? Everybody's looking towards guidance. So far, if you've given guidance, you've done well there. Tomorrow, we got Biogen, Kellogg's, Office Depot, still a thing, Roblox, and Ralph Lauren. Disney will get all the attention after hours, as well as Lyft, because remember, Lyft always reports right after Uber. They'll report, so they better kill it. Otherwise, they're going to look pretty bad. MGM and Take-Two Interactive, which you just had, was it Sony the other day? No, Nintendo overnight. Nintendo reported better than expected there, and higher, what do they call it? more headline games. I forget the name of it, but anyways, that's what's going on. And if you're curious about the debt and everything going on out there, we will make our Jazz After Dark the full rundown of everything that's just happened in the latest Fed report about credit card debt, supposedly at $1.08 trillion. So if you have some credit cards, it's what it is, man. Over 20% is the average rate now. Easily the most expensive debt you could possibly have now. It's a tough one. Let's take your questions here and see what we've got, and then I'll get out of your way. Jin says, does Jazz allow for purchase of bonds and notes, and are they tradable on the secondary market? Yes, we do have bonds, treasuries that can be bought and sold regularly if you wanted to. We're integrating that now with Goldman Sachs, so that should be turned on, or it should be officially turned on any day now. Yep. You think, so Tom says they're still got the cuts there. They've made no changes to that as far as what their sort of tapering of those cuts are. We are near a level in summer where they were holding prices. Think this is an opportunity to add. Well, although the answer may be yes, and I can't tell you buy something or sell something, but I like a good pullback, right? And so this is where I get stuck. If it were anything else, I'd be like, ooh, yeah, look at you pull back for me now. And otherwise strong stock or good fundamentals, it's otherwise something you've been watching and it's pulled back because, some CFO got caught in a relationship with a secretary or something, right? You've seen those things. I would normally be pretty excited. My history, in all honesty, I am not perfect, despite what this hair may say. I am not perfect. I have a bad record of buying pullbacks in oil. Doesn't work for me. I don't know. So I got a little sting, a little sour taste in my mouth and all that stuff. So it's, I don't know what to say. You work for Office Depot? Office there. I was actually, when I said that, I was thinking Office Max. Remember Office Max? There was Staples, Office Depot, Office Max. That was the one that was like just the nastiest of stores. They were trying so hard. I think they're the ones that are gone. Yeah. Tom says, was signing up for the research site give us access to? I haven't showed it in a while. Yeah, it's more of that's sort of a charitable thing for us. So we don't expect to make money off of that. But I'll start showing that more. How we come to a lot of the data that I share, all those tools are in there and stuff as well. And the wine and wealths when they apply and things. Too late to get into energy stocks? Are you saying you like the pullback and maybe something in here like it's too late? That's odd to me that you would say it that way. So I'm thinking maybe you're talking about an individual stock. Too late would be, hey, it's on its way up. Am I too late? So I think I might have to try again at that question. Docks into the good utilities he can buy. Yeah. And a client I was talking to earlier that is in, basically his whole life is in a utility stock. And he's very happy to see things recovering. Do HELOC loans have a lower interest rate? HELOC is not a loan. It's a line of credit. So that LOC stands for line of credit. And their rates are variable. So they can have some introductory rates and things like that, but typically they are variable rates. So with this bond market lately and how interest rates have been more volatile than the stock market, yeah, you could have had a moment where, and I don't know that it's right now, by the way, but there could have been times where a HELOC had a lower rate than, say, a mortgage. But actually, mine is. I have one open that's sitting open there. It's lower than the current mortgage rate, but not lower than my mortgage rate. No. Yeah, it's a candy. They're all like 10 and 10.75 now. Oh, I missed. Sure. What you're looking at there. Looking over, and McDonald's earnings there. Lower income folks on the decline, but made more from mid and high income earners. You'd be surprised the data that they can track. And now I think it's public. There are, is that saved in my browser? There is a site. I want to say it's called Stratosphere or something. I don't know that it's free. I just saw their advertisement the other day where you can quickly, and this would be really helpful, you can quickly get those metrics So they do track all that. So McDonald's will actually, you can tell by your, or they track sales by income, and they itemize it, but it's not on their sort of public, balance sheet that they report. God, I can't think of. I think it's Stratosphere. If you look that up and that's what it is, then that's a great thing. Hopefully it's free. Sorry, got sidetracked there. I'll go back because I missed, I think, some. Do you think poor demand for Tesla indicative of individual investors not jumping on this rally? Poor demand for Tesla, meaning the latest that's come out, like, hey, we're going to try to knock this whole EV thing and pretend like Panasonic with what they said with their demand and everything. If that's what you're saying there, yeah, could very well be. I think from looking at all stocks in the market here, I think a lot of people are trying to hold tight until maybe they're paying a little bit more of a fair value. But Tesla fans can be diehards. CBX hit a new low. Oh, did they get it wrong? Just barely. Yeah. So Barron said the other day that this is your price right in here. I can't say whether it is or not, but that was their advice. It has the price currently accounts for earnings and the Hess purchase there. Yeah. Financially free, finally. Okay, that's a mouthful there. Can you hold beaten down value positions in a taxable account if you're expecting growth from the value investments, or just keep the value in tax deferred accounts to limit the tax drag? So it would appear that you're saying you already have the beaten down value position. Should you hold in a taxable account? I don't have a horrible problem with that. Or just keep it in a tax deferred account. I'm good with the taxable account there. I can think of a handful of reasons outside of it. Like, you could put other goals on top of that. You could be in a high income tax bracket or something. I could say, well, now it's definitely the taxable account. You could be on Social Security or something and not have any other income. So you can see how there's, from a 10,000 foot view, there could be some changes there, but I'm fine with the taxable account. Yeah. Can't answer the questions about whether I would buy or sell something. I can say we own it, but I can't say that sort of thing. Yeah. Matt. Got it. I love it. I'm getting a lot more questions about utilities. People that are starting to go, hey, wait a minute, and healthcare as well. I get it. You guys are like me. You like a good discount there. I think the dog has run away. He's gone forever. Yeah. All right, I'm going to wrap it up there. I appreciate you guys hanging out today with us, and we will be back again tomorrow, of course, to do this all over again. Thanks for chilling, and we'll see you later.